All right. Hello, everyone, and welcome to another live stream. It's 2023, and I'm sure a lot of you are getting very keen about how these markets are shaping up. Big moves on the S&P 500, huge moves in currencies. The US dollar, is it back? Today, we'll discuss that along with our thought processes in the markets right now. Tyrone, it's good to be
very, very happy to be back, and I'm really looking forward to actually today's webinar.
Welcome to another live stream. It's 2020.
We're seeing really markets kick on, really, and very important that we actually very important work out exactly what the dollar index is actually doing, exactly what the dollar index is actually doing, and actually work out what these indices are doing as well. So now looking forward to it.
All right, so let's get into it, I guess, straight away. Today, we'll be learning quite a few topics, but in specifically, I guess the main ones I really want to focus on, or Tyrone and I want to focus on, is liquidity grabs and understanding the concepts of market opens. So what can happen around a London Open? What can happen around a New York Open? How are you going to be able to potentially benefit from opens a little bit better? So let's go down to the bottom left, Ty, and get started with talking about scalping strategies. We've got a few people joining us today. Make sure to do that thumbs up and all of the good stuff if you enjoy this type of content. And we'll just quickly give a shout out to Super Boyavan. I think it's Battlegar. That's Gecko, Ken Sears, Leo, and of course, Dave as well, and Amrat. Great to have you here as usual. I see a few members that have joined and been around for a while. So Ty, let's talk about these ideas. Now, how do we trade market opens? Well, traditionally, market opens usually create liquidity. And then if you think about liquidity, it's really a very interesting concept. Market opens build huge amounts of volume. What happens around 1 hour to even 30 minutes before the open can really have dramatic ramifications to the actual open itself. And when you're trading opens, you have to get in early. And what I mean by that is I need you to do diligence, just like you always do with charts. You have to be probably about 1 hour before doing the analysis, getting ready, drawing up the previous session's highs and lows, which we'll talk about later on today's video. And then we're looking for signs. Now, often Tyrone and I say patience, react, don't predict. What does that mean? Well, it means that we want to have the patience to spot a trap around the buildup of liquidity at the opens, and then we want to react to that. We've seen some examples actually in the market that opened only a few hours ago for London, and what has happened since that point, some liquidity traps that were actually there. So we'll show some of those examples today. Also, we want to think about some other concepts of why supply and demand can be so helpful during these periods. So lots of stuff coming up in today's show. If you have questions, feel free to put them in the chat. And as always, we'll answer as many as we can. So I'll just quickly take us away for a second there, and we'll switch over to this chart. We've shown this one before on the channel, and it's just important to think there are many different wordings for different setups. So in general, when you're thinking about the markets building a position, in general, they will build a position with some kind of horizontal price action. That could happen during the Asian session, which is very common to have like a sideways market. And then during the London Open, we could have a break to the upside or potentially the downside. This is a huge component of it. We could have a breakout after these consolidation periods. Now, some people will call this consolidation a channel. Some people will call this consolidation accumulation or distribution. And some people will call this range supply or demand. They all mean very similar things, but Tyrone, it's important for us to be able to look for these zones, isn't it? Because these, what these show us is that the market is building a position, getting ready for a large move. And that's what we're really interested in, the large move. No one wants the small move.
100%. And I think it's important to actually understand what it actually is. It doesn't really matter what it actually is. It doesn't really matter what it's called. Understanding that it's actually building up. Understanding that it's actually building up. That's the important part.
Yeah, it's the build up. It's understanding the orders that have been placed, and then of course the move from that point. So let's now take a look at the ideas of supply and demand. I'm sure most of you are aware of it. We do expect that some of you have some, I guess, preconceived or at least some idea of how supply demand works. But in general, I always bring up the same kind of concept here, and that's where we talk about really what Wyckoff had to say. And whether it's Druckenmiller, whether it's Wyckoff, whether it's another one of your favorite investors or traders, they all have very similar quotes. And you'll notice that a lot of the quotes are talking about the study of force or basically thinking outside the box. If it was as easy as to following a trend, then everyone would be doing it. And they do say the trend is your friend. There is no doubt that following trends and being in the direction of a 2-hour, 4-hour swing when it comes to market opens is fantastic. And we'll discuss that today as we break down a chart soon. But Wyckoff said successful tape reading is the study of force. It requires the ability to judge which side has the greatest pulling power, and one must have the courage to go with that side. And this is a great quote because what it tells us is it says that we need to think outside the box. We need to be effectively a pig, as I like to call it. Druckenmiller calls it being a pig. How can we see bigger players such as algorithms in the market, which we know there's plenty of them, building a position? And it brings us to our first concept, because when we're discussing this, we need to think, okay, well, firstly, what kind of pairs should we be trading? If we need to be studying the idea of force, then we probably also need to be studying highly liquid trading pairs. If we're trading something like the Turkish lira, sorry for anyone out there that might be loving the Turkish lira, it's going to be a little bit harder to trade it with a scalping day trading mindset. Why? Because it's going to be more fundamentally driven. If we're trading thing like a gold or a major currency cross or any of the things we've got here on the screen, it's more likely there are algorithms present in that and also an abundance of retail traders. Now, Tyrone, I don't know about you, but I would always choose to take advantage of us, the retail traders, wouldn't you?
I absolutely would. And Tom, I'm going to pull you up for 1 second. I'm getting information in my ear that you need to roadcaster mic to the roadcaster mic. Echo, apparently, to get rid of the echo. Apparently.
Okay, I can do that. 1 second.
If that's possible, we should be able to get rid of the echo. Sorry, guys. We should be able to get rid of.
All right. See how that goes, and just say something. Type. See if it fixes it.
All right. Hopefully that's fixed it.
Okay, we'll see in the chat.
There we go. Yes, that has definitely fixed it because I cannot hear myself. So yes, we are back on and we're going to really rock and roll now. So no more. You're not going to hear double tie any longer. So all right, Tom, sorry about that, but we're good again.
Okay, fantastic. So basically, we're talking about the idea of retail traders kind of being a thing that the market does prey on. To a degree, it does. But more importantly, it realistically is about how a market builds a position. And I want to discuss this when we lead into this idea of liquidity grabs. So traditionally, you see a market and you might see price action coming down to a level. Then the market kind of builds a position through a zone. Now, Wyckoff said that in his idea of supply and demand, that basically a market would build a position, and it would build a position in such a way that it would do it through having to effectively get as much liquidity as possible. Now, it makes sense. If we think like a bank or we think like a larger institution, how are they going to build positions quickly? Well, they need to be able to get the liquidity. That means they push directions such as false breaks on each side. If they push a new low, what's that going to do? It's going to force people into potentially placing shorts. If they then swing that low later on, and I'm sure a few people in the chat have had this happen to them and then push it up, what does that do? The stop losses that were here have been hunted, and then the market will move off in the direction. And this tends to be a big thing that happens around session opens. In specific, well, if we're talking about one that happens all the time, it's got to be the London Open with currencies. So we tend to see a lot of stop loss hunts. Now, why does the market build a position like this? Well, for lack of a better term, let's use this example. Let's say a hedge fund manager or a bigger player wanted to buy a position. And we'll just assume that they're interested in buying a position between these prices, Tyrone. So we've got $14, $13, and $12. If we are interested in buying this position, then they'd say that they'd like to buy it between 14 and 12. They don't want to buy it lower than 12. They don't want to buy it higher than 14. So they're only interested in purchasing it around this price. Now, they might need to place hundreds and hundreds and hundreds of millions of dollars, if not billions of dollars of orders. So it may need to sit there for a little while. And this is why these things happen, because it needs to build liquidity. Remember, when a stop loss hunt happens, and you have a buy order, that buy order becomes a sell order, effectively a sell stop. So you are getting kind of like played here to create liquidity for somebody that has the foresight to know the new price. It's a very important concept, isn't it, Tyrone, to build?
Very, very important. And I think people might be surprised, actually, how little volume, especially in our country, actually that happens, where you do have to actually build a position. Like, you can't just go in with a couple of $1 million and take a position in Telstra in one hit, or even take it in one of the banks. It doesn't happen. I know it seems like probably a relatively small amount of money compared to what insos trade, but even in Australia, like $1 million or $2 million in one position actually has to be put in parts, doesn't it, Tom? I mean, and it's incredible. We experienced that firsthand. And believe it or not, I mean, I'm probably letting go of a bit of a trade secret here, but there are little mini algorithms that actually add the positions and keep them hidden on lines to actually build positions like that. So, and it's such a small scale. I mean, it's almost ridiculous that we're talking about it, because they're not, we're just like a drop in the ocean compared to big traders, but it does happen, and it's a thing. So it's not really a big surprise that actually does happen on the really, really big orders. But I think people might be surprised, especially in some of the smaller indices and countries, how little it does, how little you really need to put in before that actually starts to happen. And 100%, it doesn't really matter whether it's going to be at exactly 12 or exactly 12.50. Somewhere in between that zone, as an example, is the average price. And that's what they're really trying to accumulate.
So just before we go any further, Ty, we are about to jump into some charts, and I want to show an idea or a concept of a scalp that could have been had today on one of the majors. And we do have a quick disclaimer. So let's just quickly put that disclaimer on the charts, and we'll see you in just a few seconds. So just like magic, we've moved over here. Now, what I've additionally added here is just a basic indicator. This is using TradingView. And of course, the great thing about Pepperstone is you're able to get access to TradingView. All you need to do is connect, I guess, that particular trading software with Pepperstone. Now, over here on the right-hand side, I've just set up an indicator that you can easily get, which is called Sessions, London, New York, and Asian. And this is kind of like the essential thing, that something like this is what you're going to want to have on your charts. And you're going to want to set it and make sure that you're then ready to look at, of course, the different levels and be ready before these markets come in. Now, something I've done just to make it a little bit more clear to everybody is I've labeled it with a slightly higher opacity and a brighter color for the two that I really like, which is the London, New York session. And then for the Asian session, I've just graded out a little bit. And that just makes it a little bit more simple to see on the charts. So when we're talking about liquidity, of course, this yellow session is the London area. So this is the pound CAD. Now, whether it was the pound CAD, the pound US dollar, or anything like that, it's always going to be interesting to look at these particular types of pairs and to basically plan out your session based on the previous highs and lows. So if we plan out here and we think about our previous low, we can actually label that. We're going to put it here. I'm just going to put a line, and I'm going to go to settings, and I'm going to label it the Asian session low. So the Asian low in terms of the area that we saw. Then I'm going to go over here, and you can see the Asian high was over here. And we can, again, label that if we wish to. Simple, type it in, and you'll end up doing this quite a lot on charts. Now, can anyone tell me in the chat something that happened leading into and just on the beginning of the London session in terms of price action? What happened and then suddenly it went somewhere else? Can anyone see it?
It broke the bottom and then went up.
You're not allowed to answer this. What is it? It's not a democracy here, Ty. I mean, I want the chat. The chat's smart. The chat's
sorry. I misunderstood. No, okay.
It has broken the bottom. It took the bottom, and then effectively it's moved up. Now, what that usually is, especially with something like this, is you've got to think about it as the liquidity side. And effectively, the market was building a position potentially here where we can see the storyline. And the storyline was wicks. We have wick purchases. This is just a 10-minute chart. Could be a 5-minute chart. You'll see wicks on most of these timeframes. And there's clearly someone that they like this. They like this price. Someone likes this price. I don't know who it is. I don't really care who it is either in particular. We have to assume it's a big player. The big players love the price. They've done it during volume periods. So clearly it's fairly defended. Notice the volume is relatively high over these periods. We don't use volume that much in FX, but certainly worthwhile looking at. And then over at the beginning of, as somebody mentioned here, the Frankfurt Open kind of aspect, we get a sweep of the low. Now, when that sweep occurs, particularly when we have a low, we have a high, then we have a lower low, and we sweep that level, making, in this case, the higher high, there's a great chance that this market will, even if it pulls back, will continue on in that direction, because effectively it has created a stop loss hunt. And this is something that, if you can recognize it on markets, it does tend to happen quite a lot in markets, and it tends to happen a lot around opens. So there are other examples we could obviously bring up, but you can see the ramifications of what's occurred, and then it moves to that next level of resistance or supply pretty quickly. It's a good little trade. And from, even if you got the, let's say you waited until the market broke through, which is pretty much what you should have done, you would have, let's say, entered here. You would have had your stop loss underneath that, because you've already seen the swing, so you don't expect it to swing it again. So it gives you a great level to put your stop loss. Some things I like about this, Ty, is once you have the patience to react to this, well, you already know where your stop loss has to be, underneath the swing.
Exactly.
Why? Because if it swings it again, it's probably not going to be very good.
It's a dead trade. It wouldn't matter where you had your stop loss after that, because it's a dead trade.
It's a dead trade.
And that's really important.
Yeah.
And a lot of people might think that, actually, you know, is this something new? Is this a new phenomenon that's just sort of kicked in, you know, in the COVID times? Absolutely not. When Tom and I started trading many years ago now, like even in the 07, 08 days, we were referring to those sorts of things as, we called it London fake out. Actually, that was really what it was called. What really was, it was a London fake out, where, quite often the first move would be the wrong move. And it does. And although we've relabeled it now, and it makes more sense to, now we actually understand it. At the time we didn't, and we were always looking for, potential, fake out that did kick in. But now, as we grew our knowledge, it makes more sense as to why it does what it does. And now it's almost like we're expecting it. It's more about, waiting for it to happen, because it's actually a really cool move. When you look at it, Tom's 100% right that you cannot absolutely stop loss any bigger than that. You can't have your stop loss any bigger, because it really, if it comes and takes that low again, you do not want to be in that trade any longer. So there's no point having any bigger stop loss. So I think what used to be a terrifying thing for traders, being the London fake out that used to take out so many traders, has actually turned into something that's actually very tradable, with a good degree of accuracy, and really something that you almost can't stuff up.
Well, at least you're given the evidence that you need, and it's not about instantly saying, "Whoa, I know that's a fake out," because you don't know how much it could fake out by. So here's just an example taken from a previous session, and again, I just wanted to show you it. This is a few days ago. And this is, again, the Asian session set up into the London session open. So all we've done, again, is super simple, is we've taken the low liquidity period, which is traditionally kind of that back end of New York into the Frankfurt Open. And we've just taken the low, which we should label, and then we've taken the high, and we're literally just sitting there waiting, doing nothing at all. So we've got the patience. We set an alert above, and then all of a sudden the market comes and grabs that zone. At that point, I would certainly be looking at lower timeframes. So what do we need to see? Every single time you need to see something, though. And the general thing that you want to see is, if you have, let's say, some kind of swing coming into it, I personally, Ty, and some of you out there may prefer to do this, is to see the market actually swing that low. So once it takes that low, what that tells me is that this was a false break. This was most likely a stop loss hunt, and that it will want to move towards at least the bottom or the top of the Asian session. And that can be a very good take profit zone. So out here, of course, it went much further than that. You might have had some there and some there. But I find that traditionally at this area here, you can basically place the sell on this information with take profits here and potentially down in these lows. And why do we use supply demand? Well, supply demand can help us to find those locations, whether it be the take profit levels or whether it be these entry zones. Now, this is only a beginning of course, an overall system, but you can see that if you're watching it, in many ways, these will provide better risk reward trades than your traditional setups, won't they, Ty?
Oh, most definitely. And I think actually I was going to touch on the risk reward. Look, these can be really, really profitable, especially when because the thing is, when you know you've got a very defined stop loss that's actually very close to the market action, because it just simply doesn't need to be any higher. The rewards can be like, sometimes they can be 4 or 5 or even more to 1, just trading an open of a market. And that's a no nonsense trade. Like, that's a pretty serious trade there, right? And when I say, you can't really stuff it up, it's more about you can't really stuff up your stop losses, right? Because there's nothing worse, and we see it all the time. People get jittery where they're putting a stop loss. They either make it a little bit too close or they make it a little bit too far away. And both are pretty bad scenarios, because if you have your stop loss too far away from action, then you're really messing with your risk reward, because you can't actually place the right size trade for what the rewards are going to be. And of course, if you have it too close, you're in danger of it actually stopping you up before it goes in your direction already. So with the setups like these, when I say you can't really stuff it up, I mean that you're either going to get it right or you're not going to get it right. But if you don't get it right, you've had the stop loss in the exact place that it needed to be. And you never feel bad about that, because you know what? It doesn't work every single time. But if you know that you've placed the stop loss in the right place, and your take profits are going to be in the right places, more often than not, you're going to get the reward that you need, and the rewards are going to be far bigger than the risk. And that's the whole point. You get to absolutely pinpoint where you need to put your placement of your stop losses. Really, really important.
So I've literally just picked 2 days out here, Ty, and this was, of course, the Monday session with the take. This is, of course, the Tuesday session. Now, the euro US dollar didn't take the lows, so you probably wouldn't have been able to necessarily pick this up with a break of the session strategy. But yeah, look, this was actually one of our first strategies I can think of that we used, Tyrone, and a huge portion of it was understanding when the market breaks out these lows or highs, how it interacts with coming back in is super important. So here we have, let's say, a break of the low. Now, the reason why you may not have taken a long here is because it breaks the low, but it doesn't swing past that high. See how that strategy saves you? Effectively, you need to see the switch. So if the market had come in like this, let's say it'd come in like this, do, I can buy. In this case, that's not what it did. It went bang, straight through the zone. Then it recovered. Then it made an equal low. Then it came back and it didn't get above that high. So there was no trade. And that saves you from making a terrible mistake in the particular market open. Now, it may mean, oh, there's no trade. I'm going to walk off for the day and do nothing. This is just one pair. If we convert it to, let's say, the pound US dollar, so we bring over the power US dollar and obviously load up the Pepperstone platform over here. And then we think about what we've got going on with the market conditions. We're, of course, looking for, again, those session highs and session lows. So you always want to look, did it swing? So over here we have it, and I've got to set it up for the different GMT time here, Ty, but you can see it actually swings most likely the time that was the Asian area, and it takes that low out. I'm not sure whether that would have been the build of Asia, but yeah, if this was the build of Asia, then that low gets swung. The pound CAD definitely did swing. The euro, of course, swung on the Monday. So the first thing we want to be talking about is set up your Asian highs and lows for the session. Look for breakouts, but do not trigger them. Do not trigger them unless the market actually makes the swing in the opposite direction. That's where most people make the mistake. They assume any breakout will be faded, and therefore it is false. How do you know that? I don't know that. Tyrone doesn't know that.
No one knows that.
We just don't know it. Does anyone in the chat know?
Yeah,
maybe you
that's
do.
with the patient. If you think you know it, you're wrong.
You're most likely going to get in some trouble, I think.
Yeah, patience is the key word there. Like, yeah, that's the first part of the our motto up here. Patience is key, because if you wait for the confirmation, it's giving you all the information that you need. You don't want to be, this is not one of the things you want to be preempting. It doesn't happen every single time. Sometimes it breaks to the low and continues on. And although you might say, well, the stop loss was low anyway, it doesn't really matter. We still don't really want to take losses unnecessarily. If you take a loss on a trade that just simply didn't work out, well, you cop that. But when you're preempting and sort of having a stab that it's going to do something, you're going to be, wrong a lot more than you need to be, and it really can break a good system down. So patience is just so important there.
Yeah, I think it's really the essential part of making the better investment decisions or the better trading decisions. I usually want to stick with this strategy to those majors that we had before, but look, that's just one of them. Setting up your high, setting up your low, looking for a break of a side, but more importantly, having the patience to activate the position. Let's jump back into the slides here and just quickly talk about some extra things that we do need to discuss. And the first one is going to be, of course, price action in general. When you're talking about switches in markets, it's not just, especially with scalping or day trading around market opens, the important component is busting the previous high, okay? So if this market is coming down and then it goes high and then it comes down and then it goes high and then it goes down and then it goes like this is not sufficient to activate this particular trade or these types of systems. And you have to break this previous high, okay? So this previous high over here, the lower peak as it was coming down, or if we call it a low, a high, a lower low, we need the higher high. If you don't see the higher high, no trade. You can't do it because otherwise you're stuck within effectively a structural range. And that's a very big key that a lot of people make mistakes of. Tyrone and I talk a lot about the lightning bolt. The lightning bolt definitely does start new trends. So obviously there's a low here, there's a higher low, and then we get a higher high. But what the importance of a lightning bolt has to do is it also has to break the previous structure. So you've got to think about it twofold. Markets, when they create these breakouts from the session highs or session lows, and you can set up a whole bunch. I remember when Tyrone and I used to set up about 20 pairs, and we would wait for false breaks, and then we would trade either real breaks or false breaks. But we found false breaks to be the better one after a long time of doing it and doing a lot of analysis. This was one of the things that really changed the game in terms of structure. Simple, basic, makes sense though. It does make sense. So get down and dirty in the 5 minute, 1 minute, 3 minute charts, Ty, and you need to be ready for that. Same thing on the up ends. You need, of course, that high, that low, that higher high, and you can't just have this as a switch. It must break that lower low. So you really want that kind of turn when it comes to these market conditions. It's pretty important it does that.
Most definitely. In my streams, a lot of you hear me talk about the very clean lightning bolt. And the clean lightning bolt is one of those ones that is actually very, very clearly defined. That's what we're talking about here. You don't want little mini zones being set up there because you are in danger of getting caught up in that consolidation zone, which actually, when you're looking for a change of trend, is actually a bit of a trap. Because although if you identify the consolidation zone and trade it for what it is, it's actually quite a good trading method, especially on a scalping, very small time frame. But if you're trying to actually look for a change of trend and you enter in one of those consolidation zones, it's actually a real trap because you're actually not expecting the market to do what it's actually going to do and actually consolidate in that zone, and it's going to whipsaw. And guess what whipsaw does? Whipsaw takes out stops. So it's really, really important to identify the market that you're trading. If you understand that you are trading a consolidation zone, all power to you. There's nothing wrong with that, but it's understanding that you are doing that and having your stop losses and you take profits in the proportionate size of that consolidation zone.
Yeah. There's a question coming in here from Leo, and it says, what about when it breaks the swing low high, then goes back to your stop loss? Well, if it takes your stop loss, so be it. It is trading. You're never going to have a 100% system. Ultimately, you're looking for something that's better than 50-50, that offers you a better risk reward than 1-to-1. If you have a 60% system that makes you 1.8 to 1 or 2 to 1 or 3 to 1 or something like that, then you're kicking ass. So really it's more about being able to keep consistency in your trading technique and not really being too scared of it. When you pull them off, I like to think of it as this. There is a certain level of fear in markets when you're buying positions. So let's say in this aspect, you see the market, let's just assume, let's assume this is the Asian session low. So the Asian session low is here. The market swings the low, effectively creating a stop loss hunt. Let's say for the sake of analysis that there were lots of wicks previously. That tells us something very interesting. The market is clearly liking that level. What is this? It's most likely building liquidity for a final slingshot move. The market then breaks to a higher high, and then it actually pulls back. Should you, and I ask this to the chat, A, be scared, B, think about potentially a further scale in if your system was that, or C, do nothing, okay? So remember, your stop loss in all circumstances will be here. You've currently seen the market go to a higher high. You've seen the market take the low. You've had the patience to wait for the market to do something around that session open. As someone mentioned before, again, Frankfurt Open into London Open tends to be a great time. So it's taken the low, it's broken the high. You might have scaled in a portion. Should you consider more here? Should you do nothing? Should you be scared? The answer usually is going to be that you want to traditionally consider a scaling in technique on your market and actually maybe even buy a little bit more, because of course, as it gets closer to your stop loss, your risk reward ratio becomes better and better and better because your stop loss is really tight for the amount of risk. Now, obviously the stress goes up, but that's why you need to create those replicatable systems. And if you're getting something as good as potentially a stop loss hunt technique or a liquidity grab technique that happens around opens, they tend to offer really great opportunities. So Dave says here you would scale in again. Yeah, you would scale in, or you would have a strategy around that. So Ty, the closer you get, although it seems scary, realistically, you've seen what's activating it. So it shouldn't matter if it gets close to your stop loss, should
exactly
it?
Right.
As long as it doesn't take it. That's the main thing.
Yeah, and I think that's right. And just on that, to finish that question for you, Liao, hopefully I got your name right. Sorry if I didn't. One thing you must not do under any circumstances is, if it does take out your stop loss and you've placed it correctly, do not attempt to try and get in again. Because if the stop loss is there for a reason, that trade is broken, that setup is broken at that point. Do not be sucked into potentially revenge trading or thinking, oh, it faked me out again, but I reckon I've got to go. If you know you've put your stop loss in the right place and it's taken you out, let go of that pair for that day. It is done. Do not try and get in again, because the stop loss is there for a reason. And that's why it's so tight. It's not, let's have a go 4 or 5 times and see how we go. The stop loss is there once. If it gets close, no problem. Scale in, continue, because the setup is still intact. But if the stop loss is taken out, basically that session is taken out for you for that particular strategy. So just be mindful of that.
So Wyckoff, this brings us on to the second strategy. The first strategy is setting up the Asian high-low. We particularly like that. You can then, if you wish to, set up the London high-low and look at New York around those periods. There was an old adage that whatever London and Asia would put on, New York would reverse 61.8% of it, Ty. Funnily enough, a golden or a fib ratio of it all. But the next one we want to talk about is, of course, supply demand generally. So the 3 laws of Wyckoff, we've talked about them before. I'm going to skip over them. Watch one of our live sessions from last year. It may help you out. The first one was, if demand is greater than supply, price will rise. If demand is less than supply, price will drop. And if demand equals supply, no significant price change would happen, and there would be lower volatility. The last one would look like this: demand equals supply. What would we get? Effectively a range-bound market, potentially an Asian session where the market's trapped within a zone. So it's a great level for us to be looking at. Now, his second law was, of course, the law that stated that if there was a difference in between supply and demand, they were not random, and they instead came after periods of market preparation. So it basically said that if we have a range-bound market, and let's say it goes and takes liquidity and then it jumps off, that if it returns back to that, well, what he was saying was this was effectively the cause and the effect was the huge move. Now, we want the huge move, but the problem is often, unless you see that hunt technique, it's very difficult for you to assume that this move is going to happen. That's guessing. I don't really like guessing too much. I like at least educated guesses as best as possible. So what could we do around session opens that potentially the market will come and do quite a lot around session opens? It may come back for liquidity. So if we think of it this way, this is clearly going to be labeled as supply once it breaks to the downside and makes a move. We now know that this is supply. The orders that were placed here by what Wyckoff stated was the composite man were, no doubt, pretty strong. They led to a big sell-off. If the market comes back to this zone but later on, then could it be interested in picking up that price? Remember before we talked about the idea of how markets would get into a price. We have $12, $13, and $14. Remember that idea? Well, they would love to buy or sell in this case at $12, $13, and $14. They want to sell more there. They want to get more positions placed. Tyrone said before that we couldn't even get enough positions placed here in the Australian market. It's true. Sometimes you can't. So when the market comes back to those zones, we see it as opportunity. It's opportunity, Ty. And it could be happening at what time? Potentially on a smaller time frame, it could be happening at a session open, effectively creating that liquidity effect. So that's something else that I like to look at, Tyrone, when it comes to session opens or around those periods. Have we got a market coming back to a previous period in time where it was setting up, let's say, as a supply or a demand? So over here, let's say, for example, we have a market such as over here. So this is the Asian area for a previous day. Then we get, of course, our London period and our New York period, and the market comes down. And then the market, for some reason, chooses to go back up in between the London period and the New York period lap over. And of course, the back end New York, it comes back. So when it comes back to this previous period, which we know has already sold off the market, could there be an opportunity for us to get involved in the sell? Well, there certainly could be. And it could be as simple or more simple than you think. One of the techniques that I like to do is actually grabbing a fib out, looking at the move that London's put on. So in this case, this is the London move, and literally just scaling it out with a basic 61.8 fib. And if the market has come back and the 61.8 fib is lining up with that previous clearly supply, clearly the market building orders to go to short, this could be a decent scalping opportunity. So it's just a 61.8, and all it's saying is just saying around market opens, whether it's a New York open, whether it's a London open, is it coming back to a previous day's consolidation period? Something to think about on your charts. What do you think about that?
It happens a lot more often than people will think. So definitely, if this is all going a little bit too fast for you, make sure you catch the replay. The replays are available on the same link that you joined in this webinar. Watch it as many times as you need to, because I think in time you will realize that although this is an advanced webinar, we're not talking about things that make no sense. These things are very, very tradable and very easy to isolate when you actually do understand what you're looking for. So be sure to watch the replay if you need to understand it and get a good understanding of it.
So this was the previous session. This is the session afterwards. We get a build of some kind of order. I don't know who it is, nor do I care. I can just assume it's a bigger player. That order leads to a sell-off. This happens to be in the direction of the general trend at this stage, which is obviously down. You can see that. We're just using a 10-minute chart. It doesn't really matter. And then what we're looking for is a pullback back into that zone. So basically into that range. Remember, think of it as 12, 13, 14. You don't know which price they're going to take, but what you do know is the higher it gets into those ranges, especially if it's stacking with these types of ratios, it tends to be a pretty aggressive type of trade or trend. So I like these types of areas. They're more replicatable. They're more conceptually, good. They make a lot of sense to how a market would build a position. And, you want to get involved in the liquidity. You do not want to be a retail trader traditionally in mindset. Let me give you some examples now of why you don't traditionally want to be a retail trader in mindset. So let's have a look here at Euro Odd. So we're going to load Euro Odd up, and we're going to do an exercise with everyone. And I don't know this. I'm just guessing that these are the types of things that we're going to be seeing. But here we go. Let me load Euro Odd over here. Okay, so we can see that for the last 2 days, the market has been going down. What do you think about retail's positioning on this right now? And I want the chat to get involved. So chat, you get involved and you tell me or tell Tyrone and I what you think is going on here. Do you think that predominantly retail traders are long or short this market right now? So are they buying or are they selling? Let us know in the chat. And while that happens, we will talk amongst ourselves, Tyrone. I want you to give some wisdom out there. Let's see if we've got some wisdom to impart on people while they answer this question.
A lot of people fall into the trap of not actually divulging their secrets. Like a lot of people who actually trade are worried that someone else is going to know what they're doing, where other traders like to follow the herd. So if there's a herd mentality and market's going in a particular direction, they want to be in that particular direction. What we're trying to say here is not really trying to, not join a trend or not actually do what everybody else is doing. What we're trying to say is to understand what the big money is doing, because that's the important part. Now, if you're trading like we've just explained, and the herd mentality is to go in your direction, that's all the better. That makes it even better, right? So don't get caught into the trap of, I don't want to be doing what other traders are doing, or I want to be doing what other traders are doing. Do what makes sense and try and do what the big money is doing. Now, what we've talked about today is big money liquidity grabs, trying to fill positions. That's where you want to be, no matter what the herd is doing, because the herd is the retail traders, right? Make no mistake. When people are referring to the herd, they're not talking about Goldman Sachs. They're talking about the average Joe placing their trades in basically big numbers of quantity. So it stands to reason, and this is why very, very key levels that people expect to hold often get tested, broken, and then it goes and actually in that direction. So really, I guess the best thing that we can say is, trade with the big money, not what the herd is doing. If the herd is with you, great. It's not a reason not to take the trade. But if it's not with you, but the big money is, and you see a setup like that, don't be afraid. Don't look at the sentiment indicator and say, oh my God, everybody's short the Euro USD. I've got to go short because that's what the indicator says. Because generally that's contrarian. So make your own decisions and go with the big money is what we're trying to say here.
Craigos ruined it. Craigos already given the answer. Yes, it turns out that retail at this point, at least from the liquidity providers you can see, are about 70% long this pair. And I can tell you they would probably have already been long this pair a little while ago. Yeah. So what it's telling you is it's really saying that traditionally, most people will actually try to counter. And you really need to think back to when you first, I always go back to the day that I placed my first FX trade. And I still remember it. Firstly, it was way too many contracts. I thought, I don't want to even talk about how many contracts it was. I remember I thought 20 was small. Anyway, the point is that I put it in. This is a very long time ago. And then we got a little win. How easy is this? Put on the Bloomberg television. Listen to some person talking about something. Oh, he doesn't know anything. I know what's going on. And guess what? I was generally and traditionally, I'll put my hand up, going against the actual trend of the higher timeframes. Because guess where I started, guys? Where you did too. Were you looking at daily and weeklies when you first started trading? Unlikely.
No.
At the 1 minute, 2 minute, 3 minute, 5 minute, 10 minute chart. So even if you're a scalper, you've got to think about the small timeframes and the big ones. So yes, I would say for over at least 24 hours, the majority of retail traders have been long this pair and getting shellacked. And it's not, I'm saying that I know that this was going to go short. I'd have to have a look at the smaller timeframes to figure it out. But overall, that's what's been happening. They've been getting destroyed. And that's traditional through everything. If we look at something like the Euro US dollar recently, every single person was trying to short it. On Friday, that happened. But what happened in the entire months leading up to that was mostly getting destroyed, trying to short it. So what you want to be doing is thinking about breakout strategies. If the false break goes again, let's say we have a trend and that trend is up. Okay. So we're going to assume it's up. Then we get an Asian session and it builds a position like this. We've got some beautiful wicks going through. The Frankfurt session happens. It spikes the bottom, takes the high, comes back. Oh, we're excited about long it. Why would we be? Why wouldn't we be? The market is overall up on the 1 hour, on the 2 hour, on the daily. If that's the direction, and then we check sentiment, and sentiment is negative on the pair, this is what I say, Ty. Yes. I like that very much. And it's just, unfortunately, it might be terrible to say such a thing. That was a bad click by me. But what it is it does show you that traditionally a lot of people get it wrong in the beginning. So you've got to think about that. Yeah.
I can't believe Craigo ruined it for us. Craigo would be one of those people that would be sitting in those trivia nights and Googling the answers. You want him on your table. Craigo's definitely coming on our table. You're on our table at the trivia night, Craigo.
That's true. I remember there was this, I did a trivia recently, or when I said recently, during COVID pandemic, and it was like, oh, you can't use your phone. So of course I was cheating on my phone. Look, I'm going to be, I was trying to cheat. And then the questions became so difficult.
His watch. Google search his Apple Watch.
You couldn't even Google search sometimes. They'd be too smart. They're too smart. They got past that. So the euro odd is just showing the example, and it is realistically just another one of those ones. Now I could read out some others, and I'm sure most of them traditionally would be going the wrong direction. So let me load up something like maybe this one here and have a look. So that the market here is 85% short. Is that what you're seeing on the chart? No. It isn't what you're seeing on the chart. There's 85% of people are trying to short it. So it's probably why it's getting, all riled up towards the bullish side. Now, a little while ago, I remember this last year, everyone was trying to buy it.
Yep.
And it was just getting destroyed. So it can be something to help you. And of course, you can use the Pepperstone sentiment indicator that comes, I think, with the advanced trading tools, Tyrone, with MT5, I believe. So maybe you want to have an MT5 account as well, and then be able to load up that. And to also just have a look whether you're seeing something that other people aren't seeing. And if you are, and the trend's going in that direction, it's very good. So I think, Ty, we'll hand it over some Q&A because we always like to get questions coming through. We've already done so much stuff on supply demand here on the channel, so definitely go back and check it. I wanted to show some examples of the previous sessions, the Monday, the Tuesday session for some of the majors, and to really drill it into people's minds in 2023 that it may be worth considering markets not as not going with the trend, but is probably going against, unfortunately, some of our peers. And if you see a replicatable system, because that's what you need, you've had the patience to react to it, then that can seriously help you out. So, we'll take some questions. Feel free to ask anything. And as always,
it still does certainly blow my mind still. I still can't get it in my head why somebody would be trying to actually short a market that's actually making a series of high highs and higher lows. And I know everybody does it at the start because I reckon it's human mentality almost. They want to reverse a market. They feel the need to reverse a market because they don't believe it can go any higher. But really understanding price action and working with it is the biggest advice that we can give you. When you're fighting, and this is why the sentiment trader is always, not always, but almost always a contrarian view, because people seem to want to fight what's actually right there in front of you for all to see. And that it blows my mind. But, that said, we were no different when we first started. So the quicker you get out of that habit and actually trade what you see rather than what you think, I think it's going to be a lot better for you.
All right. Well, if you're interested in starting 2023 a little bit differently, we're past January. We're past, the New Year's resolutions. We're past dry January, or all those things that people usually never live up to, Ty. But if you did and you want to make a change, then of course you can check out our special deal over on the Scalping Masterclass. We cover topics that we talked about tonight, plus a whole bunch more. There's obviously a deal that's special for Pepperstone. You can use Pepperstone Scalping 25 if you're interested. I'm going to read some chat here, Ty. I'm looking here at the Gecko Trent, and he says, Craigo, can you do my trading for me, please? Gecko Trent must have had a tough 22. Look, it was a hard year, no doubt. And there is a few other things here. Quite a lot of commentary about shorts versus long. A lot of you did get that right. And Dave says here, give the guys a pat on the back for the great content and hit the like. Well, if you do smash the like, it would help us to bring this type of content. So I think what we're liking to do in 2023, and you guys let me know in the chat, let Tyrone and I and Pepperstone know, are you interested in kind of looking at more of these types of live market examples coming in? Obviously, they're not solicitations to do anything in particular, but to have a look at recent price action from a few days ago to current to a week ago, and to see how some of these things actually have worked out in markets, and to do a bit of a discussion into those concepts. I'd be always interested to see whether you like that. Is that something that you're looking for? Let us know in the comments after or during this recording.
Also, and let Pepperstone know. Yeah, absolutely. Let Pepperstone know, let your account managers know what you would like to see, because look, we want to make the content all about you. Yeah, Thomas and I have been there, done that, and we want to bring to you what is going to be most beneficial to you. Yeah, we believe that yeah, a little bit of theory and then putting it into action on the live markets is the best way forward, and that's what we do in our live streams, about 20 times a week. So if that's what you like, really highlight what you want to see. And Pepperstone are fantastic in supporting their people. They want to bring you what you want to see. So please let us know. Don't be shy, because yeah, realistically, the content is all about you. And we love doing live analysis. We love doing teaching and live analysis at the same time, because to us, it really shows you. I think there's nothing like learning on the job, if you like. I think that's probably the best way to learn. Yeah, going through theory only can be very, very boring, but seeing it actually play out on an everyday level, even if it's over the last few weeks in current markets, I think does actually help. So please let us know, because we're gonna bring you the best that we can for what you want to see.
Yeah, and that's a huge component of what we're trying to achieve here and what we like to achieve. On a bigger scale, of course, you can see other things that have occurred recently. Sometimes you'll be looking through markets, and just one thing I would do is just try to spot these things occurring and how often they do happen. Spot things that come back down to the lows and then test those levels. Spot them when they break to slightly new highs and slightly new lows, and then what occurs around those points. Even last week, we saw the dollar index go below a previous one. If you're not using DX1, if you're using actual DXY, you'd notice there's a low that's about here, different futures close times. And the market swept it. It ended up reversing and led on to an incredible rally opportunity. So maybe only like a 2-to-1 or 3-to-1 style trade, but still an incredibly good trade. So from all of us here at Pepperstone, and of course, Tyrone and myself, we hoped you enjoyed today's session. We covered some great topics. To reiterate, so you remember, it's always about understanding the Asian session has the least amount of liquidity. Often it will range bound. Frankfurt Open into London Open tends to have a lot of false breakouts. Make sure you apply a concept where you're always keeping replication in it. You can bring whatever system you want in, but that's just something that we're looking at. And then, of course, do remember that there are those old rules around New York reversing a certain part of the London and Asian session. And if that happens into a level of supply or demand, hey, maybe that's an opportunity as well. Thank you so much for joining us today. We hope you enjoyed it. Sorry about the audio issues at the beginning. And Tyrone, do you have anything to say to the people? Say to everyone in the community?
Just a big welcome back, and looking forward to a great 2023. So yeah, thank you for joining us and giving us your time tonight. And we look forward to seeing you in the next 2 weeks for our next webinar for Pepperstone.
All right, great. Thank you so much, everyone. We'll see you next time. Bye for now.